Gold is getting really scary, approaching
Yeah.
$4,000 an ounce, up 46% in the year, the best year since 1979. I was only 15. I remember
Mm.
that one. Yeah, well, I wasn't trading then,
Yeah.
but it's just the significance how much it's doing it. But it's basically virtually all risk assets, most notably stock market, are underperforming gold this year. And you mentioned some other ones, all the industrial precious metals. Remember, there's four
Hmm.
precious metals: gold, silver, platinum, palladium. Now they're catching up versus
Hmm.
gold, but the
Hmm.
signals are quite disconcerting. The key thing I like to point out is we're seeing this record run in gold, nearing that major threshold. I think it's just a matter of time it prints that 4,000. Markets might run numbers, but it's happening in an environment with volatility in the stock market about as complacent as it's been in 5 years on a 60-day basis. The thing I want to mention, I think most notable, is that gold just loves President Trump. His nuances are wonderful, and gold, every time he says something, I think gold smiles.
Gold is nearing a historic threshold that could reshape global markets. Pushing close to $4,000 an ounce, the metal has surged nearly 46% this year, its strongest performance since 1979. What makes this move even more striking is that it occurs during one of the calmest periods of volatility in equity markets in 5 years. Stock market complacency, rising geopolitical tensions, and a surge of inflows into gold ETFs all point to an underlying shift in capital flows. While industrial metals and silver are rising in gold's wake, the real driver remains the relentless demand from investors and central banks, who continue to treat gold as the ultimate reserve asset. MikeMcGlone, senior macro strategist at Bloomberg Intelligence, emphasizes how gold's rally, ETF inflows, and long-term investor positioning suggest this is more than just a speculative burst. It reflects a deeper global reallocation of capital. Gold's run may test both resistance and support levels in the months ahead, but the big picture remains clear. This is a pivotal moment for precious metals. Now, we present the clips from MikeMcGlone's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Gold is getting really scary, approaching
Yeah.
$4,000 an ounce, up 46% in the year, the best year since 1979. I was only 15. I remember
Mm.
that one. Yeah, well, I wasn't trading then,
Yeah.
but it's just the significance how much it's doing it. But it's basically virtually all risk assets, most notably stock market, are underperforming gold this year. And you mentioned some other ones, all the industrial precious metals. Remember, there's four
Hmm.
precious metals: gold, silver, platinum, palladium. Now they're catching up versus
Hmm.
gold, but
Hmm.
the signals are quite disconcerting. The key thing I like to point out is we're seeing this record run in gold, nearing that major threshold. I think it's just a matter of time it prints that 4,000. Markets might run numbers, but it's happening in an environment with volatility in the stock market about as complacent as it's been in 5 years on a 60-day basis. That's very rare. So when you get volatility that low, the lowest 60-day volatility S&P 500 is running below 9%. Again, it's worse before COVID. There's little room for it to go up, particularly as we enter that volatile time of year. And we're
Hmm.
just ending the slow period time of year. And gold might be front running a little bit of some issues. So what I'm just looking at happening is gold right now, I think, is stuck between 4,000 and 3,500. 4,000 is significant resistance. I just went back and looked at decades, years, even, depending on what days. It's such a stretch from any normal moving averages for heading higher
Yeah.
that for it to get above that level, it's similar to a lot of peaks in past. The most like one I really like compared to was when we hit 2000 and 2020. That peak lasted for 4 years. And then it's got that good level of support down 3,500. That was April's low. So I think it's stuck between this level for a while. And in Q4, it can test both
Hmm.
and really not matter too much. But the big picture is what the stock market does. If the stock market doesn't roll over, stays resilient, volatility stays low, we do same old stuff, easily gold could 8 to 10% get right back down to that 3,400 level. It's still up a lot in the year. I mean, that's well over a third, which puts it in the top like 8 of the last 100 years on an annual basis. And that's just how far stretched it is. But what's really happening significantly lately is this major shift to inflows and gold ETF inflows. So gold ETF total inflows now, our measure on the Bloomberg says they're up almost 20% this year. To put that in context, the last 4 years, there were outflows. So that's switched very positive. And the last time we had a really good inflow year was 2020, and they increased almost 30%. So we're on a pace as 2020. But what happened in 2020 was a major shift in the global world order. We had COVID kick in, the biggest money pump in history, and volatility spiked. Now it's the opposite. We're getting, another shutdown, kind of getting used to that in the States.
Hmm.
We have the thing I want to mention, I think most notable, is that gold just loves President Trump. His nuances are wonderful. wonderful, and gold, every time he says something, I think gold smiles. Total right now, about as far as COMEX open interest is about a third, maybe 33% of total open interest. Last year's big run up when we first started getting towards that 2,600 level, they got up to 45% of open interest. That's about as high as it gets. So those overweight longs are way curtailed, and it's shifting more to long-term investors. But that's just a good way to measure. I think managed money net positions are just a good way to measure where you might get excessive bullishness and where you might hit stops if the market rolls over a little bit. But the bottom line is the deepest pockets in the planet are still buying, and that's central banks, and they're a lot harder to measure, particularly as you see the war escalating and wars escalating in Europe. And things like Mr. Trump are saying that we might, encourage Ukraine to take back some of their land. This is just, it's almost a perfect storm for gold. But I point out long term, all those indications I have, you go 4,000 anytime soon. It's such an overbought level. It's not a level for most investors to be laying into new longs, but I'm concerned of what it means for the macro, and that's potential. Just the potential. Here's the key thing I'm worried about. Just a little bit of minor reversion in S&P 500 volatility. So right now, the VIX volatility index is running 16%. The average for the year is right below 20. Say we pop up to near 20, kind of means nothing in the big picture. And the thing is, do we stay above it by the end of the year? And that's why I think the fourth quarter of this year is going to be significantly telling for what might happen for the next few decades. That's the key fact. Remember, silver is known as the devil's metal for a reason, because it trades 2 times the volatility of gold. So on a 1 to 2 year basis, it's up a little more than gold, 60%, and 1 year basis, gold's up 50% or so on a 1 year basis. That's a bad sign. When you get almost the same performance at double the risk, it's not a good sign. So I look at silver and still bullish silver. I think it's probably put in a pretty good support level around 40, probably going to make a new high around 50, just a matter of time. But it's in a similar bucket. Every day that goes by, it's much more industrial. In a similar bucket is copper and platinum and palladium. They're all following in that space in precious metals. Remember, there's 4. They're all following beta and gold, and central banks aren't buying anything other than gold, but they're catching up. It's a question how far, and they also face competition from things like cryptocurrencies. Right. But the difference is, I like to point out, most of these precious metals, a basket of these precious metals on the year up almost 50%, and you look at a basket of cryptocurrencies, they're up maybe 10, 20%, yet they trade 60 times the volatility. So what you're seeing there, I think, is gold leading all the precious metals higher. There's only 4 of them. And then you see Bitcoin leading some of the cryptocurrencies higher, but there's millions of those. And there's so unlimited supply is going to always pressure the prices. In a demand pull economy, when you have a country like China, who creates most of the solar panels in the world, really expanding economically or not, they are completely pumping their system to stay afloat. There's debt to GDP is running 300%. Money supply is running $45 trillion, almost more than double the U.S. So it's a severe deflationary force there. And silver is just reflecting that potential global tilt towards a recession that you're seeing in crude oil. And then you have to ask yourself, when's the last time we see some substantial upward revisions in global GDP estimate growth? So right now they're still facing this paradigm shift of tariffs from the world's largest goods importer, the U.S. And so silver's stuck in the middle there. It's in the same bucket as copper, and I think that's why I'm worried that if we get a pickup in volatility, all the metals on the planet that are much more industrial than gold will suffer, continue to compare to gold, and they're only really rallying because gold's making them go higher. And again, there's substitutes. I mean, silver's for jewelry, platinum and palladium can be used for jewelry. So when you get the price of platinum to the lowest versus gold in, I think it was May ever, and the gold to silver ratio got to 105 in April. That was really high. Now we're down in the lower end of the range around 82. That's just, they're all in the back of gold right now, almost all the metals.
Gold's rally has created an unusual dynamic across commodities, with the gold-to-oil ratio now signaling extreme stress in the global economy. At over 60 barrels of WTI crude required to equal a single ounce of gold, the relationship has reached levels historically associated with periods of severe dislocation, such as 1933 and 2020. Crude oil prices continue to weaken, showing little evidence of a demand pull, while gold strengthens as capital seeks safety. This divergence highlights the growing deflationary forces evident in industrial metals, particularly copper, which has been temporarily buoyed by supply disruptions and speculative momentum rather than genuine demand growth. At the same time, indicators such as China's falling bond yields and declining iron ore prices suggest a deep-seated structural weakness in global growth. In this environment, commodities such as copper and crude oil appear vulnerable to a sharp reset, even as gold remains supported by safe haven flows. If market volatility increases, the domino effect across commodities could accelerate, leaving gold as one of the few assets to maintain relative strength. This backdrop highlights how fragile the current balance is, and why precious metals are signaling deeper market stresses. Let's get back to the interview.
You look at there's right now it takes 61 ounces of barrels of WTI crude oil per 1 ounce of gold. The highest close ever at the end of the year was 39. And those 2 years were 1933 and 2020. Not really good years for markets. So things like crude oil going down and gold going up on a global macro basis, that's a very scary indication. And it just shows there's no demand pull for that world's most significant commodity, yet there is for the ancient store of value. And then what's stuck in between there's most of the other metals, particularly copper. And the question I'm really watching is, can copper stay strong into the end of the year? Yet it's kind of being pumped up for, I like to say, the wrong reasons. Potential supply disruptions and actual supply disruptions. These kind of supply disruptions usually are temporary. My colleague Grant Sporey, who covers this stuff more depthly out of London, points out typically get a 5% issue in copper supply disruptions. This year is closer to 10%. But I like to talk about the elephant in the room in terms of copper. Copper is known as the economic sensitive commodity, and on the year it's up about 20%, and the S&P 500 is up 15%. You see, it's riding that wave. Copper was up for a while, almost a third. It dropped back, the tariffs, and now it's just riding that wave of beta. So that's the key thing: is beta has to stay strong. So the elephant in the room, I think, for copper, crude oil is already tilting lower, is the stock market has to stay resilient. And then I point out, well, the risks are that might just have a little bit of a back and fill by the end of the year. That means all the dominoes tumble, but that would just be following things like crude oil. And then there's key things about really indication for copper, and that's 1.87%. That's 10-year note yield in China, severe deflationary forces. And you look at the price of iron ore, it's heading lower. Those are typical companions with copper to go higher, but they're heading lower. So my point is, if this volatility in the U.S. by the end of the year just kind of picks up a little, U.S. stock market, the dominoes tumble, and copper is the number one to watch for potentially just dropping with crude oil, iron ore, and bond yields in China. But crude oil and the grains are in the same bucket. They're in the low price cure trajectory after pumping up too high to those spikes in 2020, 22. That's usually what happens to commodities. Commodities go down towards low price cures after they go up too much. They're in the same bucket, and there's not really much to stop it right now. Also in the middle of this significant technology revolution. I mean, why does the U.S. under the Biden administration have to institute 100% tariffs on EVs out of China? Because there's massive supply of these wonderful vehicles that use no petroleum and use electricity and are just shifting the world order. And then there's a key little fact about crude oil. The last 20 years, there's been 3 lows around 40. And that's since the peak in 2008. Copper kind of looks similar as 2008's peak. And I just like to point out, it's not profound to look for a normal reversion in a commodity to go below its break-even cost to offset excess supply and demand, which we have in crude oil right now. In the last few years, it's been around 40. But we're also seeing that major shift. And that's why I think everything tilts on what's holding crude oil up. It's like $62 a barrel right now, WTI, which is below last year's low. It's 65. If you see the bent there, is the resilience in the U.S. stock market. So that's why I point out is if that we get a little volatility pickup in Q4 in stocks, the dominoes already tumbling in commodities. Look at crude oil, and that's where copper's all in the same space. So the difference is crude oil is just more significant, but it's also being replaced by technology. Part of that technology is a demand pull for copper. But when I think of like electrification, then let's talk about the best conductor of electricity of all commodities, that's silver. And that's where gold's warning there's a problem. So I think the risks are that one thing that's really striking me, if you look at things like the ratio of gold in terms of U.S. Treasury prices. Now, for bond prices, we can always go back 40 years. But if you look at an aggregate measure of Treasury prices, you have to go back to 1983, the last time that Treasuries were this low versus gold. That's pretty extreme. And this is a little reversion. On the other side of that, you look at the stock market cap to GDP in this country, it's the highest since 1929. So a little bit of reversion there is maybe what gold's figuring out. It's this question of how it happens and when. And to me, that's what I see. I see gold as just plain scary at these levels. It's just telling us there's something might be going on. And also it's getting really expensive. So a good example, 2008, gold rallied basically 30% in 2007. It pumped up a lot in 2008. And then when we hit, things really collapsed in 2008, gold dropped 20% initially and then recovered. So it's, that's why I'm worried that there is, it's made you live in interesting times, and markets are so extreme that you have to be careful. Like just talking about 4,000 gold, up almost 50% in 1 year, with the stock market fine is kind of, and with inflation still kind of, a lot high, 3%. So good examples. The last time we had this kind of rally in gold in 1979, inflation was running 10%. And this year it's running below about 3%. That's CPI. Yeah. Well, one of my favorite ratios I've watched for over a decade is Bitcoin to gold. The ounces of gold equal to one Bitcoin. Right now it's 29.5. The high when President Trump got elected was 40. The low this year is 25. To me, the risks are that this goes back below 25 as we find out that this has been a great leading indicator for the stock market and risk assets. So to me, that's a top ratio to watch. And it was way too expensive. It got to 35 recently, back in July when the VIX was very low. And now it's trickling back down as we head into fourth quarter. So it would be wonderful if we can end this year and say the VIX at 16 and still is around 16. I'm worried it's going to go back above 20. It'd be wonderful if we can keep those trends going, but we're heading towards the reality of late cycle things. And then the discombobulation of Mr. Trump, the pushing back on the Fed. Gold loves that. And the tariffs. I mean, the whole world is facing recessionary trajectories. As I mentioned, China, just look at Germany. 50% of their GDP is basically exports. So that's the scenario. If things stay boring, that's great. Then I don't know what to do. But if we get just a little modest pickup in volatility, that could set the tone for years. And unfortunately, that's why I tilt over to copper. It looks to me very much like crude oil did in 2008. It popped up to a peak in July. It got hit down by end of Q3, and then Q4 it collapsed down to 40. Copper's kind of hovering there right now, and you can see how it's basically hovering with the stock market. So copper's a great leading indicator. And then you look at gold versus everything. It's basically made a new high versus broad commodities versus copper versus crude oil. And there's only one thing it's still relatively cheap against, S&P 500. And gold's in a raging bull market. It's just getting overbought. That's what happens in bull markets. And, last year was below 3,000. That was probably a time to be overweight, and it's proving that this year. But getting near 4,000, it's probably not the place to get overweight. But that's typically what investors do. They pile on near peaks, and I just look at 4,000, such significant resistance that if I'm right about this, volatility potentially picking up in the stock market and gold being so expensive, the next big potential trade has been one of the most beat up markets on the planet, and that's good old U.S. Treasury bonds. Well, that's the thing. It's what is gold telling us? Is it a feint? Is it a false move? Unlikely. If it really collapses by the end of the year and trades below 3,400, it might indicate that. But I think it's more likely it's just going to be like this U.S. 10-year note at 4.14 is going to just kind of follow what we have in China right now, 1.87. And just reminds me of trading JGBs 30 years ago. That's what happened. JGBs collapsed. It took a while. Japanese government bonds, I should measure. And then it was just a matter of time the rest of the world caught up. And now that's kind of tilting the other way a little bit.
Markets are moving into a phase where stability can no longer be taken for granted. Inflation pressures, currency shifts, and widening gaps between safe haven assets and growth-linked commodities are all indicating a more profound structural shift. Gold's persistent strength is not just a technical move. It reflects a recognition that confidence in the broader system is beginning to fracture. Energy markets and industrial commodities, meanwhile, are struggling to maintain footing. What this means for investors is simple. The old playbook no longer applies. Defensive positioning, disciplined strategy, and attention to macro shifts are now more important than chasing short-term rallies. Those who adapt early will not only protect capital, but also preserve opportunities for future cycles. If you found this analysis valuable, make sure to like the video, subscribe to the channel, and share your thoughts in the comments. Your support enables us to continue providing you with the latest insights on gold, commodities, and the global economy. Stay tuned for more updates, because the story unfolding now is one that no serious investor can afford to ignore.